The following podcast was recorded on Tuesday, March 22nd, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Thank you, Kristen.
Today, Sam will discuss the outlook for the current inflation environment with a fast Fed. So, Sam, agreement on economic outcomes is odd. In March 2020, deflation, hyperinflation, and disinflation were popular. Today, we have a clear leader, stagflation. Do you want to take a moment to really define stagflation, and then we can talk about what changes the outlook?
Yeah, so stagflation, it's pretty straightforward. It's slow growth with pretty steep inflationary pressures. So you aren't growing that quickly and you have a lot of inflation behind you.
Okay, and really what's changed the outlook when you look past or go back to really 2020, 21, where are we at today?
Well, it's really interesting because we haven't had much of a discussion around stagflation in better part of 2 decades, right? And now all of a sudden it's the topic du jour. In early 2020 March, the real discussion was around: are we going to have disinflation? You know, the collapse in the economy, shutdowns, et cetera. How are we going to deal with this? Is it going to be hyperinflation? What is it going to be? And that debate really continued and just chopped along as the Fed cut rates to zero, as we had quantitative easing across the board, and as the fiscal policy remained incredibly loose. That really began to change when the transitory story began to change. So you went from inflation is transitory, which would have led us to some different type of outcome, to inflation is somewhat entrenched. It's going to take much longer to get rid of. The Fed's going to raise rates, growth is going to slow, and all of a sudden you end up with the stagflation outcome. And you know, it's been a while since we've talked about it, and people had to Google what that meant.
And from the perspective of the equity market, the Fed is now hiking into incredible strength. Historically in the past, the Fed has not hiked into either strong or peak earnings. How does this differ from the past?
This is the weird part, right? Where COVID for a lot of the U.S. markets was actually really good for earnings, right? You have Apple, you have Microsoft, you have Amazon, you have as all top weights within the S&P. So when you had COVID hit, it was almost called the perfect storm for their earnings. You had just absolutely ripping operating earnings. That made a lot of sense, right? So you basically are sitting at peak earnings right now with a little bit of a rollover recently. That's somewhat troubling, to be honest. The Fed typically hikes into strength in the economy, not into weakness, and that's probably what we're going to see when it comes to relative S&P earnings on a trailing basis. It's very difficult to see how Amazon, Microsoft do better in an economy that's opening than they did with a closed or COVID economy.
And what is the economic outlook for growth?
See, that's the tough part, right? Because you do have a very fast Fed. There's basically a debate and a rush to see who can predict the most hikes for 2022, whether it's going to be 50 in May, 50 in June. Are we going to have consecutive 50s? Are we going to have 50 basis point hikes for the rest of the year? Are they going to be 25 basis points? It's basically just a race to see who can predict the most rate hikes and who can predict them to come the fastest. That fast Fed is likely to constrain at least some of the growth outlook for the U.S. economy, whether it's housing. We've already seen mortgage rates pop rather significantly over the past month or so. We've seen gasoline prices rise, et cetera, et cetera. So they are going to constrain growth rather quickly by hiking this fast. We haven't even mentioned that they're going to do quantitative tightening probably starting in May. That's the pace of which is likely to be pretty quick, at least 100 billion a month rolling off the balance sheet. That's going to be that's a pretty interesting mix of tightening as we go into the second half of the year. So the outlook for growth is slower than it would have been, call it 6 months ago, when we were pricing in very, very little action from the Fed this year.
So who benefits the most in the current environment?
Who benefits the most is a really tough question. It's normally you would say you wanted to be a little defensive here as the Fed was hiking, but the question is, what does defense in a portfolio look like, particularly on the equity side? Technology has, at least in the recent past, been quote unquote defensive. It's unlikely to be defensive this time as we reopen the economy and at least begin to have some shift away from goods and towards services like going out to eat, et cetera. So it's pretty hard to say that tech's going to be the place to be. I would say we talked to, I think it was early January, that the place to hide this time around was likely to be commodities, and that turned out to be a pretty good place to hide so far. But the volatility there is pretty high. So it's likely that you're going to have, call it consumer discretionary, some of the things that haven't been as popular during COVID become actual winners here. Consumer staples, consumer discretionary, that type of investment.
And what is the outlook for risk assets?
Generally, the outlook for risk assets as the Fed begins to tighten isn't necessarily that bad. This time around, it doesn't look like the Fed is hiking into strength within operating earnings for the S&P, at least. It looks like the Fed is hiking into some weakness at the very margin. Combine that with quantitative tightening, and you're likely to see, at least on the margin, risk assets, particularly equities, probably underperform, I would say, particularly what they've done in the past. You've already seen, call it a 10 to 15% decline in 2022. That probably fits with the current environment. Overall, fixed income has been absolutely putrid. It kind of makes sense. I would say the outlook for risk assets at this time is probably neutral to negative.
So Sam, in summary today, what else should we be watching for?
That's the interesting part. What should we be watching? We should be watching for how much of the Fed's new tone continues into next week. The Fed's tone has been very, very hawkish. Whether it was Powell going with we could see 50 basis points, whether it was Bullard saying that we should be thinking about 50 basis points. The hawkish tone of the Fed and how much more they can really be hawkish is important. I would say you already have the 2-year pricing at about 2.25%. That is a very, very large jump over the past couple of months. That's doing a lot of the Fed's tightening job for it ahead of schedule. In other words, you already have a significant increase in the front end rates, regardless of the fact that the Fed funds rate has only gone up 25 basis points. So I would say how much more hawkish the Fed can be over the next week will be really, really interesting to see.
Okay. Well, thank you, Sam, for your thoughts today, and thank you, everyone, for joining us. As a reminder, we are client-driven. If you have any questions or feedback on future topics, please let us know. For any further information on Arbor Research, Bianco Research, or Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Thanks, everyone, and have a great day.